Hello everyone. In this particular recording, we're going to go through some select homework problems in chapters 5, 6, 7, and 8. Before I go through these select homework problems, I want everyone to understand that it is critical that you practice as many recommended homework problems as possible. And every single chapter has a recording where I go through the detailed step-by-step answers to the homework problems. So even though this is the Cliff Notes version of the homework for chapters 5, 6, and 7, 8, I still ask you to go through the detailed recordings for all of the homework explanations in each of the chapter modules. Okay, so this is chapter 5, first homework problem we're going to go through. Question number 16 in Chapter 5. Chapter 5 deals with capital assets and the Capital Projects Fund as well. And we have independent situations here that we're going to look at the journal entry on both the fund as well as the government-wide statements. So in number 1, the city received a donation of land that is to be used by Parks and Recreation to develop a public park. At the time of the donation, the land had an acquisition value of $5.2 million and was recorded on the donor's books at a historical cost of $4.5 million. So basically, since this land that's donated to the city is going to be used for Parks and Recreation, this is a general government transaction. So in the general fund, we're not going to record any journal entry. Remember, general fund is a governmental fund. Governmental funds use modified accrual accounting. And you guys know that modified accrual accounting, the concentration is on current assets and current liabilities. Therefore, there will be no recording of a fixed asset. However, on the government-wide statements, we will record the assets. And the asset will be recorded at the fair market value at the date of donation, which in this case happens to be $5.2 million. It doesn't matter what the donor's historical cost is. In this case, $4.5 million is irrelevant for our particular journal entry. Now, the land is a contribution. Contributions at the government-wide level are recorded as program revenues. Remember, at the government-wide level, all of our revenues are either program revenues or general revenues. Contributions are always program. Number 2, the Public Works Department sold machinery with a historical cost of $35,100 and accumulated depreciation of $28,700 for $6,000. The machinery had originally been purchased with special revenue funds. So when the asset is sold, on the governmental fund, whether it's general fund or special revenue fund, that's really not my concern which fund it's in, but really knowing that it's a governmental fund. Remember, governmental funds, the asset wasn't recorded there. It wasn't being depreciated there. So all the governmental fund is interested in recording is, I received a check for $6,000, so I'll debit cash. And the credit goes to other financing sources. There's no gain, there's no loss, there's no revenue, there's no expenditure. It's actually an other financing source. Now compare this to the government-wide journal entry. And the government-wide journal entry, we will use accrual accounting. And the journal entry is very familiar to you, I hope. This is a journal entry that you learned probably in your Principles of Accounting class. We record the sale of a fixed asset, in this case at a loss. We received cash of $6,000. I'll debit cash. I'll get the machinery and equipment off our books with a credit. I'll get its associated accumulated depreciation off of our books with a debit. And whatever is missing, debit or credit, that's a gain or a loss. In this case, it's a $400 loss. Number 3, a car was leased for the mayor's use. The first payment was $1,000. And the present value of the remaining lease payments was $29,000. The initial cash payment was made by the general fund. So in the general fund, remember, governmental fund, we use modified accrual accounting. So we will not be recording the actual asset and liability here. So we're going to record an expenditure, which is basically a capital outlay expenditure for the down payment as well as the present value of the remaining lease payments. And that totals $30,000. We wrote a check, so we'll credit cash for $1,000. And the remaining credit of $29,000 is it is the liability, but the liability is not recorded on the general fund. We will record other financing sources. Now in the government-wide statements using accrual accounting, here's where you will indeed see the asset is being recorded, all right, the leased asset, and the liability is being recorded. All right, $30,000 is the asset, $29,000 is the liability, and of course we wrote the check for $1,000. You can see these journal entries, all of them, they're drastically different between the government-wide and the governmental fund. There are some significant differences between modified accrual for the governmental fund and accrual accounting for the government-wide statements. And of course, these differences will generate what we call reconciling items. Basically, the reconciling item is the difference in how equity was affected on each financial statement. And those reconciliations are going to come in handy when we get through Chapter 9. All right, number 4. During the current year, a capital projects fund completed a new public safety building that was started in the prior year. The total cost of the project was $9,720,000. Financing for the project came from a $9,000 bond issue that was sold in the prior year and from a $720,000 capital grant received in the current year. Current year expenditures totaled $1,176,000, and the full cost is attributable to the building because it was constructed on city-owned land. So, for the current year, remember, we're building a new public safety building. That's the first thing you need to determine. Which fund are we going to record in? Well, public safety, that's police and fire. And so that is part of the general government. Construction of general government capital assets is going to flow through the capital projects fund. So first, to receive the grant money of $720,000. In the capital projects fund, we will debit cash and credit revenues. Now at the same time, the capital projects fund is recording 4A. The government-wide statements is recording 4C, debit cash. But remember, all of our revenues are either program or general. When we're dealing with grants, that is a program revenue. Okay, and next in 4B, we're going to record the current year expenditures of $1,176,000. In the Capital Projects Fund, which uses modified accrual accounting, we are not recording the fixed assets. In its place, we will be recording expenditures, and we will credit cash. Now, while the Capital Projects Fund is recording 4B, the government-wide statements is recording 4D. And here is indeed the government-wide using accrual accounting. We will record the fixed asset. And at this point, it's called construction work in progress. And the credit goes to cash. And last but not least, we said the project was completed in this year. So the last thing we need to do in the government-wide statements is we need to record the building, $9,720,000, and we'll debit that and we'll get rid of the construction WIP with a credit. So once again, you can see differences here. The government-wide, we're recording an asset, but the governmental fund, we're recording expenditures. That is a reconciling difference. Number 5, this goes hand in hand with number 4. So that building of $9,720,000, now we're going to depreciate it. It's got a 30-year life, and we're recording half a year's worth of depreciation in year 1. So the general fund, remember, we didn't record the fixed asset there. So there will be no depreciation. All right, make sure you understand that. Remember, we recorded the expenditure up front, so when we actually constructed it, you can see here in 4B, you're recording the expenditures up front. So there's going to be no more expenditures for depreciation, no journal entry. On the government-wide, we're going to do a good old depreciation journal entry, and that would be the $9,720,000 divided by 30. and then we will take that number and divide it in half for the current year's depreciation. Debit depreciation expense and credit your contra fixed asset accumulated depreciation. And last but not least, number 6, due to technological developments, the city determined that the service capacity of some of the technology equipment used by general government has been impaired. The calculated impairment loss due to technology obsolescence was $1,156,000. Once again, on the governmental fund, there is no fixed asset, so there's nothing to write down. No journal entry. However, on the government-wide, where we do have the fixed asset, we're going to record the expense for the write-down, and we will credit the fixed asset account directly. This is going to affect current and future years' depreciation, and of course the carrying value on the financial statements. So you can see here there's plenty of transactions involving capital assets. In summary, what do we have here? Number 1 was a donation of a fixed asset. Number 2 was a purchase of a fixed asset. A sale of a fixed asset. Number 3, entering into a capital lease. Number 4, construction of a fixed asset. Number 5, depreciating a fixed asset. And number 6, writing down the permanent impairment of a fixed asset. So certainly there's a lot of various transactions dealing with fixed assets, and many differences between modified accrual and accrual. Okay, now I'm going to take you to Chapter 6, which is the debt and the debt service fund chapter. We're going to go through a sample journal and sample homework problem as well, and we will take a look at question number 16. And once again, very similar setup to the homework problem we just went through with Chapter 5, where basically we are given a whole bunch of independent scenarios, and we need to record the journal entries in both the governmental funds as well as the government-wide statements. All right, let's take a look at number 1. The general fund collected and transferred $750,000 in tax collections to the debt service fund. And out of that amount, it was all spent once it got to the debt service fund. $600,000 of the amount was used to retire outstanding serial bonds, and the remainder was used to make the interest payment on the bonds. Okay, so we have both a payment of principal and interest. But first things first, in the general fund, where the taxes are being collected. So the general fund will debit cash and credit revenues. While the general fund is recording 1A, the government-wide statements is recording 1E. Debit cash and collection of taxes are always general. Remember, at the government-wide level, it's either program or general. Taxes are always general. Okay, now that $750,000 is collected in the general fund, now the general fund is going to transfer that money out to the debt service fund. So transfer out for the general fund, debit other financing uses, credit the cash, and here's the debt service fund on the receiving end of that transfer. The debit goes to cash, and the credit goes to the sources account. And that $750,000 in the debt service fund, it's not going to sit there in the cash account. It's basically immediately going to be paid. It's going to be spent. And so that's what we have 1D. We're going to spend the $750,000 cash with the credit, and the debits both go to expenditures. You will see in the debt service fund, the long-term liability is not recorded there. Remember, debt service fund is a governmental fund. Governmental funds use modified accrual. In modified accrual, we only record current assets and current liabilities. So we will record an expenditure for both the principal and interest payments. Now, while the debt service fund is recording these journal entries in the government-wide, the $750,000 is spent, but the $600,000 is a debit to the payable. Right? That is where the liability is recorded. So when we pay down principal, we will reduce it with a debit. and the interest is the expense. You can see in the government-wide statements we are not recording, we're not mentioning the transfer between the general fund and the debt service fund. The reason for that is general fund and debt service fund are both going to the governmental activities column on the government-wide statements. Therefore, the transfer in and the transfer out net each other out to zero. So there's no net effect on the government-wide statements. All right, number 2, we're going to sell a bond. A $5 million issue of serial bonds to finance a capital project was sold at 102 plus accrued interest in the amount of $50,000. So we sold the bond at a premium, a 2% premium. In addition, we sold it in between interest payment dates. So because of that, we're collecting an additional $50,000 from the bondholders for interest. All right, now, as is typical, the principal of the bond will go directly to the Capital Projects Fund because that's what they need to build the project. Any additional monies collected, like premiums, like interest, are going to be deflected into the debt service fund. And that's exactly what we have going on here. So first of all, in the Capital Projects Fund, they're going to receive the $5 million premium, debit cash, and the credit goes to other financing sources. Once again, the Capital Projects Fund is a governmental fund. Governmental funds use modified accrual accounting. With modified accrual accounting, I know I cannot record long-term assets and long-term liabilities, so I have to record the $5 million as an other financing source. The debt service fund, also a governmental fund, is getting the additional $150,000. What is that? Well, the 2% premium, 2% of $5 million is $100,000, and the premium is recorded as an other financing source. And then the $50,000 extra in interest we collected from our bondholders, that would be a revenue for the debt service fund. Now, while the Capital Projects Fund and the Debt Service Fund are recording these journal entries, in the government-wide statements, we will record the accrual basis journal entry where we received all of our cash for $5,150,000. $5 million of it is the bond payable. $100,000 of it is the premium on the bond payable, which will get amortized. And then, of course, the $50,000 in interest we collected from our bondholders, we're going to have to pay that back to them. So that's also a liability, interest payable. All right, number 3, we made a lease payment. It's a capital lease. So a portion of the lease payment is going to go to interest, in this case $15,809, and the difference, the remainder, is going to go to the principal. Funds used to make the lease payment came from a capital grant received from the Special Revenue Fund. So first in the Special Revenue Fund, they get the grant money by debiting cash, crediting revenues. As the Special Revenue Fund is recording 3A, in the government-wide statements, they're recording 3E down here, debit cash, and once again, anything to do with a grant would be a program revenue versus a general revenue. Now that $110,000 is transferred out of the Special Revenue Fund into the Debt Service Fund. So the transfer out, debit the uses, credit cash, and on the Debt Service Fund, they're on the receiving end of that transfer, debit cash, credit the sources. And then that $110,000 would be used to make the debt payment. And so we'll credit cash. And both the interest and the principal piece in the Debt Service Fund are expenditures. Once again, Debt Service Fund is a governmental fund. Governmental funds use modified accrual accounting. And so we don't record the long-term liability here. So both the principal and interest are expenditures. As opposed to the government-wide statements, which use accrual accounting. So when we make our $110,000 cash payment with a credit, we can see the pay down of the principal, we will debit the liability account. And only the interest will be expensed with a debit. And once again, the transfer from the Special Revenue Fund to the Debt Service Fund, since they're both governmental funds, they will both be accounted for in the governmental activities column, on the government-wide statements. So those transfer in on one and the transfer out on the other effectively net each other out. So there's no mention of that on the government-wide statements. Number four is a refunding. A refunding is a refinancing. Basically, when we issue new debt to pay off old debt. So what we have here is we have serial bonds with a $3.5 million value were issued in cash to permit refunding of a $3.5 million term bond. All right, so first of all, in the debt service fund, they're going to receive the new debt money by debiting cash, crediting other financing sources. And while the debt service fund is recording that journal entry in the government-wide using accrual accounting, debit cash, credit bond payable. And that new bond money is going to be used to pay off the old bond money. We will debit uses and credit cash. In the government-wide using accrual accounting, we would debit the liability and credit cash. Well, I really want to explain the debt service fund, and this is how it works. When we are receiving bond money, we credit other financing sources. That is exactly what we learned with regular bonds. When we get money from regular bonds, we would also credit the sources. But here's where it's different. When we pay down principal, in a normal situation when we pay down principal, in a debt service fund, we would debit the expenditure account. But when we are refunding, we will debit other financing uses up to the amount of new bond money that came in. Any additional monies that would be needed to pay down the old debt, we would debit the expenditure. In this case, the new debt is exactly the same as the old debt. That is why we don't have to debit expenditures here. But if the old debt was, let's say, $3.8 million, we'd have to add a debit to an expenditure here for $300,000. All right, so be mindful of that. Skip number 5, and let's take a look at number 6. A $5 million issue of construction bonds were sold at par, so no premium, no discount, and that is going to be recorded through the Capital Projects Fund. So we're going to debit cash, and we'll credit other financing sources. In addition, we had debt issuance costs of $45,000 and prepaid insurance of $5,000. Well, the sum of these two, $50,000, are all expenditures on the Capital Projects Fund. Credit to cash. On the government-wide, when we sold the bond for $5 million, we'd debit cash and we'd credit bond payable. We can record the long-term liability. Government-wide uses accrual accounting. And the debt issuance costs, the $45,000 is an expense, but the $5,000 in prepaid insurance would be an asset called prepaid insurance. And of course, the credit goes to cash. So once again, just like in Chapter 5, here in Chapter 6, we have various journal entries in various types of debt situations. Once again, what do we have? In number 1, we are collecting taxes and making a principal and interest payment. In number 2, we sold bonds at a premium plus interest. In number 3, we made a lease payment, capital lease payment, partly principal, partly interest. In number 4, we have a refunding, basically a refinancing of old bonds with new bonds. And in number 6, we are selling bonds and we're paying administrative and prepaid insurance at the same time. So 5 very different situations. And you can see bonds and liabilities in general are recorded differently. We need to really keep in mind that with modified accrual accounting, like the debt service fund and the capital projects fund, we are not going to be recording current assets and current liabilities as we would with accrual accounting at the government-wide level. All right, very good. Now Chapter 7. Chapter 7, we are dealing with proprietary funds. With proprietary funds, we're going to be using accrual accounting. So the accounting itself is not so bad. So what I'm going to concentrate on, at least for this short little video, is question 17. Now, question 17 deals with the equity of proprietary funds. Okay, so the equity of proprietary funds is called net position. As opposed to governmental funds, if you recall, equity was called fund balance. Now, getting back to equity of proprietary funds, equity is broken down into 3 subcategories. Those 3 subcategories are unrestricted, restricted, and lastly, net investment in capital assets. So, the unrestricted is basically where you can do whatever you want with the monies. Restricted net position is basically where there is a law or a third party dictating how we're going to spend that money. And lastly, net investment in capital assets. I have a little formula for you to help you with the net investment in capital assets. And that formula is as follows. At the end of the year, we would look at our balance sheet and we would figure out what is our fixed assets, less our accumulated depreciation, less any outstanding loans, liabilities, that were entered into to buy or construct those fixed assets. All right, so with that said, let's go through this homework example. There are no journal entries here. All we're trying to do, the objective of this homework problem, is to try to figure out what are the balances at the end of the day in unrestricted, restricted, and net investment in capital assets. Now, before we go through this, let me explain what you would do in the real world. In the real world, the first thing you would do is you would go through your normal closing process and you would close out net income or net loss. You would first close it out to unrestricted net position. And after you close out net income or net loss to unrestricted net position, the next thing you would do is you would then update the other 2 categories of net position. And whatever happens to the other 2 categories of net position, the opposite would happen to unrestricted. So let's say, for an example, we close out our net income to unrestricted. The next thing we would do is we would say, okay, our net investment in capital assets actually increased $20,000 from the beginning of the year to the end of the year. So what we would need to do in my scenario is we would need to credit net investment in capital assets for the $20,000. And therefore the debit would go to unrestricted net position. So you see that? The opposite. Whatever happens to the other 2 categories, the opposite would happen to unrestricted. My suggestion to do this problem is to take an 8.5 by 11 piece of paper and put it in front of you landscape-wise. And while it's in front of you landscape-wise, I'd have 3 columns. I'd have a column for unrestricted, a column for restricted, and a column for net investment in capital assets. And we're going to go through these 7 items, and we're going to decide how do these items affect each of the 3 categories. Number 1 is basically just giving us our beginning numbers. So if you're doing the 8.5 by 11 landscape paper, as per my recommendation, here are the starting points in your 3 columns. So your net investment in capital assets starting point is $679,800. Your restricted is 0, and your unrestricted is $1,354,692. All right, so those are the starting points. Next, number 2, net income for the year, $162,759. And remember what I just finished telling you a few minutes ago. The first thing we do is close out net income to unrestricted. So what I'm going to show you down here are if you can envision your 3 columns on your 8.5 by 11 paper. So our unrestricted, it started with $1,354,000, and we're going to say plus net income. All right. All right, so let's go to number 2. Depreciation expense totaled $54,000. Now, if we have depreciation expense, that means we also have increased accumulated depreciation. And remember what I said. I said fixed assets minus accumulated depreciation is going to affect your net investment in capital assets. So your net investment in capital assets, it started with $679,800, and we're going to say minus depreciation. Because whenever we have depreciation, we increase our accumulated depreciation. If we increase our accumulated depreciation, we are decreasing our net investment in capital assets. All right, number 4. A piece of equipment with a carrying value, also known as net book value, of $26,100 was sold for $25,000. So what are we saying here? We're saying we sold it for an $1,100 loss. So first of all, the $1,100 loss, that's included in the net income calculation. So we already accounted for the $1,100 loss in the net income calculation. Now what we need to understand is the $25,000, or I should say the $26,100 carrying value of the equipment is no longer with us. So that would actually decrease your net investment in capital assets. So I'm going to say minus sale of equipment. Once again, your formula for net investment in capital assets is fixed assets minus accumulated depreciation minus any outstanding loans entered into to buy or construct those fixed assets. If I sell a fixed asset, it certainly would decrease your net investment in capital assets for the full $26,100. Number 5. Number 5 is actually a little bit tricky, so let me walk you through this one. Bonds for $500,000 were issued to construct a concession stand at the rink. Okay, so when we initially issue the bond, the construction didn't start yet. So the bond itself is restricted. We can't, because the bondholders are telling us what we can do with those monies. It's not attached to fixed assets just yet. So the original $500,000 is going to increase your restricted. So restricted started with 0, and we're going to increase it. We're going to say plus restricted plus 500. But that's not the full story here. What else is going on? It says by the end of the year, the concession stand construction started. It was 50% complete. And at this point in time, my fixed asset construction work in progress totaled $248,000. So what we're going to do is say, okay, the restricted, even though we entered into a $500,000 bond, $248,000 is now been attached, if you will, to the fixed asset, the construction work in progress. So out of the $500,000 bond, $240,000 of it's spent, and it's now attached to the construction. Therefore, what's remaining as restricted? The difference, or $252,000. Now, your net investment in capital assets, we're going to say, we actually should say plus $248,000, and we should say minus $248,000. So it effectively nets to 0. What's the plus $248,000? It's the actual construction in progress. That's the balance in the WIP account. But we also have $248,000 that is attached to the debt that's not yet paid. So that would be a minus. So plus $248,000 and minus $248,000. Effectively 0, so it's not really considered there. Number 6, a $15,000 principal payment was made on a lease. So when we are making principal payments on a lease, it's a capital lease. That's the only way we can have a principal payment. And so that means we recorded a fixed asset somewhere. So when we pay down the lease, what's happening? We're saying plus lease payment. When we subtract out the liabilities to get to net investment in capital asset, when the liability decreases, the net investment in capital asset is going to increase. So we'll say plus lease payment. And last but not least, number 7, A new Zamboni ice resurfacing machine was purchased for $250,000 at the end of the year. A $30,000 note payable was associated with the Zamboni ice resurfacing machine. So we bought a fixed asset. So under net investment in capital assets, we'll say plus new equipment, but we will also say minus the note payable associated with the Zamboni. All right, so net investment in capital assets, what happened? The beginning balance was $679,800. The ending balance was $834,700. It increased in value $154,900. And remember what I said, whatever happens to the net investment in capital assets by the end of the year, the opposite is happening to unrestricted. So net investment in capital assets increases $154,900. So your unrestricted is going to decrease. Do you see we say minus the increase in net investment in capital assets for $154,900. And your restricted started with 0 and it ended with $252,000. So it increased $252,000. Therefore, your unrestricted is going to decrease $252,000. So the answers are the ending balance in net investment in capital assets, $834,700. Your restricted, the answer is $252,000. And your unrestricted, which once again we close out net income to, and then whatever happens to the other two categories, the opposite happens to unrestricted. So your ending balance in unrestricted is $1,110,551. And last but not least, let me go through a homework problem in Chapter 8. Chapter 8 was the fiduciary fund chapter. There are two types of fiduciary funds. We have custodial funds and we have trust funds. I could go through both, and of course I do in the other videos that you can listen to. But for purposes of this constrained video, I am just going to flip a coin, and I'm going to decide to go through the investment trust fund homework problem, and that is questions 10 through 14. The reason why we're going through basically 5 homework problems at the same time is we are keeping track of the journal entries on not only the investment trust fund, but the underlying governments that are participating in the trust fund. So here's an example where we have 3 governments getting together. We have the City of Albertville General Fund, we have Albertville School District, and Richwood Township. They decided on February 15, year 2020, to start an investment pool. Basically what that means is they've decided to take their investment portfolios and take them out of their own balance sheets and basically give them to the trust fund for efficiency purposes so we can invest together. At that date, February 15th, the City of Albertville portfolio balance was $900,000. So the journal entry in the City of Albertville down here, they would actually create a new asset in their general fund called Equity and Pooled Investments for the value of the portfolio at the date of the creation of the pool, $900,000. But the City of Albertville, the last time they updated their investment records was back at the end of the fiscal year. At that time, their investment was worth $890,000. So the City of Albertville will get rid of their investment account with a credit. The difference between the two, in this case $10,000, that is revenue. That is basically the change in the fair value. And you would do a similar journal entry for the school district and the township. So the school, at the time of the creation of the pool, the value was $4,230,000, but at the end of the year it was $4.2 million. So we'll create the equity and pooled investments for $4,230,000. We'll get rid of the investments with a credit of $4.2 million. The difference is the revenue is the change in fair value. The Richwood Township, they really need the help of the pool because On February 15th, it was only valued at $3,870,000, but back at the end of the year, it was worth more, $3,890,000. So the difference of $20,000 is actually a debit to the revenue account because the equity in pooled investments is less than the actual investment value, which we credited for the end of the investment balance as of December 31. So this debit to the revenue is not a typo. This is indeed a loss, an unrealized loss, if you will, which governments record as revenues. Okay, now while the three participating funds are recording these journal entries, the investment trust fund is recording their initial journal entry. The money from the city is invested in T-notes, and the money from the school district and the township is a CD. So the investment trust fund is receiving their $9 million here, broken down between T-notes and CDs. And one thing you have to understand is there is a difference between internal participants and external participants. The internal participant is basically, out of all of the governments involved with the that has participation in the trust fund, the one that actually does the accounting for the trust fund, they are considered the internal participant. And all the other governments are considered external participants. This is important because the accounting is different between internal and external participants. An internal participant, in the trust fund, we're going to record a liability. So this is the due to general fund. The external participants, we're going to keep track of their position in the trust fund as net position. So additions and deductions during the year, and at the end of the year, those accounts will get closed out to the net position account. So additions for their basically participation into the fund. All right, now that the trust fund is created, now we're going to go on, and the trust fund is going to earn money. It's going to earn interest. It's going to earn dividends. It's going to have changes in portfolio fair values. And also we can have some participants come in with new contribution money or have distributions or withdrawals. All right, so in this case, on June 15th, remember the creation of the fund was on February 15th. Now, 4 months later, on June 15th, a few things happened. The first thing that happened is the T-note value went up by $30,000. All right, so what we need to do is we need to take that $30,000 increase in T-notes and say, how do we allocate it to the participants of the pool? And the answer is we will allocate the $30,000 increase in the T-notes based on the ownership percentages at this moment in time. And so we would best be served by putting together a table. So here are the original investments in the pool that I'm highlighting, and there's the total. And so we're going to take their ownership share. So as an example, the city, their original investment was $900,000 divided by the total initial investments of $9 million. So they own 10% of the pool. So if $30,000 increase in the T-notes, $30,000 times 10%, what is the city going to get? $3,000. The school district, $4,230,000 divided by $9 million, they own 47% of the pool. 47% of the $30,000, how much are they going to get? $14,100. And lastly, the township. $3,870,000 is their original equity divided by the total pool of $9 million. They own 43% of the pool times $30,000. They're going to get $12,900. So that is how we allocate it. $3,000, $14,100, $12,900. And so that's where we get our credits. The internal participant, we're going to credit a liability. And the external participants, the school and the township, we will credit the additions account. Now, the second thing that happened on June 15th is the township decided to withdraw $3,010,000, which the portfolio was able to redeem some CDs to get that cash out of the portfolio. So, in the trust fund, they're going to redeem the CD by debiting cash, credit the CD. and then they will take that cash and turn around and debit deductions and credit cash. What is this? This is basically the check written to the township. All right. Now, what about the individual participating governments on June 15th? What are they recording? Well, all three of them, the city, the school district, and the township, they're going to have a similar journal entry where they're going to debit their new asset, equity, and pooled investments, and credit revenue. Basically, this is the allocable share of the $30,000 increase in the T-notes. In addition, the township, they have to record a second journal saying, well, thank you for the cash. We'll debit cash for the $3,010,000. And their equity position in the pool has gone down, so we will credit the asset for $3,010,000. Now, what I want to show you is, okay, once we have new money coming in or money being withdrawn out of the pool, we need to stop and recalculate ownership percentages. And so now that we know that the township has withdrew $3,010,000, we need to stop and say, okay, what are the new equity positions? And here they are. So the city original position was $900,000. They just got allocated $3,000, so they now own $903,000 of the pool. The school, $4,230,000 plus the $14,100 they were allocated. They now own $4,244,100 of the pool. And the township, they own $3,870,000. They were allocated $12,900, and then they withdrew, so we say minus $3,010,000. They now only own $872,000 in the pool. And when you do the math, how much does the city own of the pool? $903,000 divided by $6,020,000. They own 15% of the pool. The school district, $4,244,000 divided by $6,020,000. They own 70.5% of the pool, and the township, they are down to 14.5% of the pool. This is important because when we allocate interest, dividends, changes in fair values, in the future, we're going to base it on these new percentages. So what's happening? These were the June 15th entries, and now all of a sudden, September 15th, and so in the pool, September 15th, we received interest on the T-notes of $50,000. It was collected. So the trust fund is going to debit cash, and they're going to credit this temporary account called undistributed earnings. And at the end of the year, CDs accrued in the amount of $28,000. So we'll debit the interest receivable, and we'll credit, once again, this temporary account called undistributed earnings. So now we're going to take the undistributed earnings, which $50,000 and $28,000. It's got a $78,000 balance. So what I'm going to do is at the end of the year, I'm going to get rid of that $78,000 credit balance. I will do so by debiting the undistributed earnings to make that balance go away. And how am I going to allocate the $78,000? Once again, we will allocate the $78,000 based on the ownership percentage at this moment in time. And so at this moment in time, come down to our little table. Here's the $78,000. We will multiply it against our ownership percentages. And so the interest going to the city will be $78,000 times 15%, or $11,700. The school district, $78,000 times 70.5%. They get $54,990. And lastly, the township, $78,000 times 14.5%. They're going to get $11,310. So here are these three numbers. Remember that, $11,007, $54,990, and $11,310. Those are going to be the credits. The debit to the liability for the internal participant, and then, of course, the credits to the additions account for the external participants. And what do the other governments do? Well, here is the September 15th and the year end. We're going to say the city, they get $11,700. Debit the equity and pooled investments, credit revenues. Same thing for the school district for their share, and Richwood Township. So hopefully this all makes sense. Once again, there is a difference in accounting for the internal participants and the external participants. Make sure you know your difference in accounting. And of course, make sure you understand how we initially create the portfolio, the investment trust fund, and how we account for interest, dividends, and changes in fair values. And of course, all along, we have to remember to update our ownership percentages every time there's a new contribution in or a withdrawal out of the trust fund.